In my previous video, we discussed fixed and fluctuating capital account methods, and today we'll discuss practical questions based on fluctuating capital account. First of all, about this question. This question was asked in mock test of CUET 2022. Let's begin. Mango and Banana are partners sharing profits in 3:2 ratio. Their capitals were 5 lakh and 3 lakhs respectively. As their partnership deed, Mango was entitled to a salary of rupees 10,000. Banana was entitled to rent of rupees 20,000 per annum for his personal property that he had let out to the firm. They were entitled to interest on their capital at the rate 10% per annum. The firm earned a profit of rupees 1,60,000 before the above adjustments. What amount will be credited to Mango and Banana's capital account if they follow a fluctuating capital system? Now see that to find out the answer, first of all let's scan that there are 4 options given, whereas Mango's amount is different in all cases, whereas for Banana these two options are having the same amount. So to do these type of questions, if we are able to calculate Mango's share, the answer for Banana we don't need to calculate. Let's begin now. Now we have to see that what is the amount to be credited to Mango's account. Since it's a fluctuating capital, all the benefits are to be given to the partner in the capital account only. So the salary, interest on capital, and the profit be given to Mango, as well as Banana. But here Banana is entitled to a rent of rupees 20,000. This rent is a charge, so charge will not be recorded here before we if we have to give the profit, right? So let's see. So first of all, the profit before rent is given 1,60,000. Out of that we are subtracting the rent, that is 20,000. Now we are left with rupees 1,40,000. Now the amount to be credited to Mango is first the salary rupees 10,000, interest on capital to be calculated at 5 lakh at the rate 10%, so that is 50,000. Profit 50,000 multiplied by 3 by 5. To find out the profit, let's see how we have calculated. So this profit of 1,40,000, out of that we should subtract the salary, then we should subtract the interest of Mango, and then interest of Banana also. Right, the interest was 10%, for Mango, right? That was 50,000, and for Banana it was 10% of 3 lakh, so that is 30,000. After subtracting the salary, interest of both the partners, the amount of profit left was 50,000. That should be given to the partners in their 3:2 ratio. So the profit of this 50,000 being given to Mango at 3 by 5. So that comes out to be 30,000. If we add the benefits given to Mango, that is salary, interest on capital, and profit, that is 30,000. So total becomes 90,000. So in this case, option A is the right option. Option A is right, because as in the beginning I discussed that Mango's amount is different in all 4 cases. If we are able to calculate Mango's share, the Banana's share is not needed to be calculated. So here option A is correct. Question number 2. In this question, please see that the fluctuating capital, we are going to use the fluctuating capital. Why? Because the question is silent about the method of capital to be used. Another thing, this question was asked in the CBSE 2023. Let's begin. After doing the adjustments regarding drawings, rupees 40,000, share of profit rupees 24,000, and the additional capital introduced rupees 32,000. The capital of Ashok, a partner, as on 31st March 2022 was rupees 5 lakh. His capital as on 1st April 2021 was. So the question is actually asking about the opening capital. Closing capital is given in the question and we have to calculate the opening capital. So before moving on to calculate the closing capital, let's understand that whenever the opening capital is given in the question, we do various adjustments during the year. Like additional capital introduced during the year is added, drawings made during the year subtracted, and the profit earned during the year is being added. All these are the adjustments. When these items are adjusted in the opening capital, the resultant is the closing capital. So in this question, closing capital is given, whereas we have to calculate the opening capital. Now if we move on to the reverse direction, we will be able to calculate the opening capital, right? So here you can see that we have been given the closing capital. We will subtract to nullify the effect. Reverse means we have to nullify the effect. Then the drawings will be added and the additional capital will be subtracted and the answer will be the opening capital. So here you can see the closing capital 5 lakh and then we are subtracting the profit of rupees 24,000. Further, we are adding up the drawings and subtracting the additional capital. Why we have done this? Because closing capital is given and we are moving into the reverse direction. We have to go to the reverse, then we have to nullify the effect of all these items which were adjusted, right? And thus after adjusting these items we get 5,16,000. So option B is the correct answer. Let's move on to the next question. Now this question was asked in the CBSE sample paper 2021. Which of the following is true regarding salary to a partner when firm maintains fluctuating capital accounts? So here the method is clearly given and we are asked about the salary. So salary is a benefit, right? We have discussed that salary is related to profit and loss appropriation account and it is being transferred from this to partner's capital account, right? So let's see the option number first, debit. It should be debited to partner's loan account. So loan account we need not to read further, that is a wrong reference. Then debit profit and loss account. Profit and loss account is not involved at all, so no need to read the other part. Then comes a C option, debit profit and loss appropriation account and credit partners current capital. See, these two options are almost the same. Just see, these two all are same. The difference is only the partners current capital or partners capital account. So when we maintain the fluctuating capital account, we maintain only one account, that is partners capital account. So here the profit and loss appropriation and partners capital account is involved. See, we are not going in detail, that is what is to be debited or what is to be credited, because here if we just been able to make out that only two accounts which are involved are correctly given, right? If other options would have been the same, then there was need to find out the in-depth information, that is what is to be debited or credited. So here these two options are almost correct, whereas only the difference is this current capital and partners capital. So here since we are having the fluctuating capital account, thus only the partners capital account is maintained. So option D is the correct option. Now let's do the next question. Partner A and B are there in a partnership firm with capitals of rupees 2,50,000 and 1,50,000 as on 1st April 2024. Each partner is entitled to 9% per annum interest on capital. B is entitled to a salary of rupees 60,000 per annum together with a commission of 6% of net profit after charging his commission. Net profit for the year ended 31st March 2025 amounted to rupees 2,12,000. Prepare profit and loss appropriation account and partners capital account when capitals are fluctuating. See, the question is clearly informing us that the capitals are fluctuating. In this, we are asked to prepare P&L appropriation, and when capitals are fluctuating, we will be preparing only partners capital account, only one account. Now let's begin. The profit and loss appropriation account for the year ended 31st March 2025. By profit and loss account, this is the net profit given in the question. You can see this is the net profit transferred here. Further, we have to give all the benefits to the partners like interest on capital, then salary, commission, and the profit, divisible profit, be divided between partner A and B. So interest on capital for A is at the rate of 2,50,000 at the rate of 9%, which comes out to be 22,500, right? Whereas the partner B's capital is 1,50,000 and at the rate of 9% per annum, we have to calculate the interest that comes out to be 13,500. The total of the two will be recorded here. Then salary given for B 60,000 per annum. Then we have to give the commission to B rupees 12,000. Let's see how we have calculated commission for partner B. So here it is being informed in the question that commission should be calculated on net profit after charging his commission. So after charging his commission, then this formula is to be utilized, where commission is being calculated by net profit multiplied by rate upon 100 plus rate. This is the formula. So 2,12,000 was the net profit multiplied by 6 upon 1 upon 100 plus R. 6 is the rate of commission given in the question. So that comes out to be 2,12,000 multiplied by 6 upon 106. We just cut this. It comes out to be 2,000, and 2,000 multiplied by 6 gives us rupees 12,000. So commission is being recorded here. Then after this, we have to subtract these three items from the total of 2,12,000 to find out the divisible profits. These are the divisible profits. Let's see how we have calculated the divisible profits. So the total credit side is 2,12,000 minus 1,08,000, that is salary plus interest on capital plus commission of the partners. The difference comes out to be 1,04,000. Now this 1,04,000 is to be divided between A and B in their profit sharing ratio. The question is silent about the profit sharing ratio. Thus, as per the Partnership Act 1932, equal profits be divided between the partners. So A's profit comes out to be 1,04,000 multiplied by 1 by 2, that is 52,000. So both the partners are getting equal profits, right? Now let me summarize. Here profit is being transferred and the benefits given to the partners out of this, these are being given. After subtracting these three benefits, we get the divisible profit of 1,04,000, which is being divided in equal ratio between A and B. After this, we have to make partners capital account. Now see that yesterday we discussed that the partners capital account, if we have to connect with P&L appropriation, all these items are to be transferred to partner's capital account on the credit side. So let's see how to make the partner's capital account. So partner's capital account for the year ended 31st March 2025. The first item we have to record is by balance brought down. This is the opening capital. Right, opening capital given in the question 2,50,000 for A and 1,50,000 for B. See, we had calculated the interest on opening capitals only at the rate of 9%. Now these are the benefits we had recorded in the profit and loss appropriation account on the debit side. We are transferring all these benefits here also. So once we have calculated, now we can write here by interest on capital account 22,500 for A, 13,500 for B, salary to B recording here, by commission recording in the B's column, then profit transferred from profit and loss appropriation account 52,000, 52,000. Now on the debit side we do not have any item. Now the total of 2,50,000 plus 22,500 plus 52,000 gives us 3,24,500. So the credit side 3,24,500 minus the debit side, which is 0. Thus the balance carried down comes out to be same 32,500. Right? Similarly, this side also 2,87,500, that is the credit side, minus the debit, which is 0. So the amount comes, the closing balance comes out to be 2,87,500. So here same, this is the closing capital of the partners. Right, so as per the question demanded, we have prepared the P&L appropriation account as well as the partners capital account is also being prepared. See, or we have given the salary to the B, we have given interest, commission is also been given, whereas the commission was being given after charging his commission. Thus the capitals are also maintained as per the fluctuating capital account. With this, I just want to inform you that tomorrow we'll discuss more about the fixed capital account and the questions based on that. Please do subscribe and like